All right. Today is Tuesday, the 28th of February. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. And let's begin with this. Happy last day of the month. I think we did close on a positive note in the stock market today. Matter of fact, give us a look at the last minute candle for today's activities and... Oh, no.
What a mess.
This is not good. This is not good. Closing on a negative note for the month and probably a teaser for a march from hell. If you know anything about the stock market, you know that the month of March is really important. Major stock market bottoms and major tops took place in the month of March. My hunch is this will be one for the books. And of course, we know that the Fed is way behind the curve. And now they have to play catch up because the battle against inflation is getting out of hand. And tomorrow, the first day of the month, we're going to have an important Fed speaker coming out, also known as the demon from Minneapolis, Neel Kashkari. Now, if you watched my analysis on the mystery Fed zombie who did vote for 50 basis points in the last meeting, I came up with the conclusion that it is Neel Kashkari from Minneapolis. And now we know that that is the case for sure. Minneapolis joined St. Louis and Cleveland in pushing for 50 basis points discount rate hike in last month. So we know that we have at least 3 members now in the bag will vote for 50 basis points in the next FOMC meeting. And more voices about to join. And the stock market right now is not even pricing anything near 50 basis points in the next meeting. If it becomes clear that the Fed is moving toward 50 in the month of March, we're gonna see a reckoning, folks. We're gonna see a major leg down, perhaps erasing the entirety of the year-to-date rally. So buckle up. What's really amazing to me watching the stock market right now is the insane gambling that's going on. At this stage, after all what we've seen in 2020, 21, 22, forget about the dot-com, forget about 1990s, we're talking about 2 years ago, a year ago, even a few months ago. And folks are gambling at this stage on zero date till expiration options, distorting any price discovery in the stock market. The gambling mania is getting out of hand. I mean, look no further than Cathie Wood from ARK Invest. At this point, she should have lost all credibility. Nobody should believe in this false prophet anymore. She only got a hot hand in the last few years because everybody did. The Federal Reserve was pumping the stock market higher via quantitative easing. And the biggest beneficiary in the quantitative easing pumping is non-profitable technology stocks, high beta stocks, anything that remotely resembles tech growth companies. All of these stocks shot up higher beyond any reasonable valuation because valuations did not matter when the Federal Reserve was doing quantitative easing and pumping assets prices higher. And everybody looked like a genius in the last decade investing in the stock market. All what you had to do is not fight the Fed. Let the Fed pump and you ride the wave along with them. But now that we don't have quantitative easing anymore and the Fed is moving to quantitative tightening, now we're finding out which investors and which money managers are the real deal and which ones were just false prophets and they got lucky because they rode the wave with the Fed. One of them, of course, is Cathie Wood. By now, everybody should know that. But here's Cathie Wood. She comes out on TV yesterday. We got folks buying and investing in ARK Invest right now at this stage because they believed whatever Cathie Wood was selling yesterday. I'll give her that. She's a good saleswoman, one of the best. But the fact that investors are falling for this at this stage is absolutely insane. But the insanity aside, folks, we have a lot of confusion right now about the economy and the stock market, where we're heading right now. Even the most seasoned economists and experts are now confused. I was listening to Larry Summers the other day, Mohammed Al-Arian. All of them say that this environment is challenging and confusing. And I say, maybe not for me. I'm not confused at all. I know where the economy is heading. I know where the stock market is heading. It is nothing new, folks. We've seen this movie before, but maybe some of you forgot. So I'm going to walk you step by step. What's going to happen to the economy, where we're heading, what's going to happen to the market too. Without further ado, here it is, in focus tonight. Confused? Are you confused about the economy and the stock market? Well, maybe no longer after you watch this video. Now, I've been explaining to you folks that the natural evolution of any inflation cycle, if it gets out of hand, inflation becomes stagflation. Why does it become stagflation? Because at some point, prices get out of hand. The ability of companies to raise prices is limited because the consumer is going to run out of money. Yet the inflationary pressure due to expectations and the psychology continues to stay with us. And we have the phenomenon phenomenon of sticky inflation combined with deteriorating economy, hence stagflation. At some point, stagflation either naturally evolves into a recession, and that happens when the consumer runs out of cash and out of ability to rack in more credit card debt, and they no longer have the ability to stimulate the economy. They lose their jobs, and they have to get rid of assets, and we see asset prices collapsing across the economy, and it becomes a recession. Or, just like we got back in the 80s, we get a Fed-induced recession. Stagflation evolves into a recession because the Fed tightens the monetary policy, specifically by raising rates significantly higher, and they fast forward the stagflation part all the way into a recession and reset the cycle again. But we have this delusion that's going on right now in the economy where folks thought that we could have something called transitory inflation. We can have an inflation phase that resolves itself because inflation is a supply problem. We told you in this channel this is absolute lunacy. Inflation has always been a monetary phenomenon. When the Federal Reserve prints money out of hand and overstimulates an economy, you get inflation. It's not due to supply problems. But of course, they said, oh, it's due to the thing shutting down all of these supply chains. Once everybody rolls their sleeves and they get the shot, we can go out and the supply chain will come back and inflation will go away. But we now know that this is bullshit. And we told you that exactly in this channel. Now they have another fantasy that, oh, okay, inflation was not transitory, but we can fix it. We can have a soft landing. We can go back to the expansion phase. In this channel, we told you and explained to you in details that we have the expansion phase, followed by the inflation phase, then the recession phase. And in each phase, different sectors of the stock market tend to outperform. In the expansion phase, we get technology, cyclicals, oil, and industrial stocks outperforming. Now, in the inflation phase, we get energy, materials, value, and consumer staple stocks outperforming. And this was exactly what happened back in 2020 because we were in the inflation phase. In 2020-21, we were in the expansion phase, and therefore technology stocks, cyclicals, industrials, even energy outperformed. And the assumption was that since inflation is about to evolve into a recession, we know that for sure, we have to move into the recession playbook in 23, where healthcare, utilities, packaged food, fast food, tobacco and alcohol, and bonds tend to outperform. But this is not what we've seen so far. Matter of fact, these sectors are the underperformers year to date because we have this lunacy that took place that, oh, the Fed is going to pivot because inflation is going down. We're going to have a soft landing. So we have to move back into the expansion phase. We have to buy technology stocks, cyclicals, industrials, and assume that everybody's going to live happily ever after. Inflation is over. The Fed got it. No more need for QT and more tightening and raising rates. It's over. We're back to expansion. This is the delusion that took place, which, by the way, opens the opportunity. Now that we know for sure we're going to go back to the recession phase, all of these stocks got absolutely hammered. My hunch is when we get to the recession stage, not if, but when, they will take back the leadership. In this channel, we also talked about the inflation theme versus the recession theme and how bond yields and the dollar impact equities. In the inflation theme, when bond yields and the dollar go down, it's good for stocks. Why is that? Because when yields go down, when the dollar goes down, they go down in anticipation of less Fed rate hikes, less Fed tightening, and this is good for the equities market. In the inflation theme, when bond yields move higher, when the dollar moves higher, as we're seeing right now, this outcome is bad for stocks. Why? Because they go higher in anticipation of more Fed tightening, more rate hikes. Now, in the recession theme, we're not there yet, but we're gonna be. When bond yields go down, along with the dollar, this is actually bad for the equities market. Why? Because when the 10-year yield goes down, it goes down in anticipation of a worsening economy. Likewise, when the dollar goes down in the recession theme, it goes down because the Fed at that stage is re-stimulating the economy by easing the monetary policy. Why would they be doing that? The answer is because at that stage, the economy will be under a severe recession and the Fed will have to rescue the economy. But we know from history that when the Fed's actual pivot happens, it happens for the wrong reasons because the economy is under a recession. And therefore, when bond yields go down, when the dollar goes down, and you see stocks also going down, you know that we are in a recession theme. Yet when we see bond yields in the 10-year moving higher along with the dollar, yet we see the equities market also moving higher along with them. This is yet another confirmation that we are in a recession theme because bond yields go higher in anticipation of an improving economy. The dollar goes higher because the economy no longer needs the Federal Reserve stimulation. But we're not at this stage yet. We're still in the inflation theme. And we talked about the delusion From the bulls side, for example, what was the reason behind the stock market rally year to date? It was the assumption by the bulls that either the Fed pivot will happen, meaning inflation is cooling down and there is no longer any need for more Fed rate hikes. The Fed is going to pivot, pause interest rate hikes, a matter of fact, start cutting rates at some point, and the stock market rallied based upon that assumption. But then after we got hot economic data, and I say hot sarcastically, from the employment report, but most importantly from the inflation reports, be it the CPI, the PPI, the PCE, it became clear that the Fed is not going to pivot. The Fed will continue to raise rates because inflation is not going down as we hoped so. But the bulls found another opening to remain stubborn and to continue to buy the stock market and assume that some good outcome will happen after all. If it is not the pivot, it is the soft landing. That, hey, look at consumer spending. It's hot, hot, hot. So the Fed can raise interest rates all they want. The economy will be able to absorb it. And therefore, we have a soft landing, and this justifies the year-to-date rally in the stock market. Now we're getting more evidence that that is not the case. That the consumer is actually spending more because they're racking in more debt to cope with inflation. And the underlying conditions of the economy are actually deteriorating. You look at the PMIs, you look at the manufacturing data, you look at consumer confidence, all going down in the toilet, which solidifies the case that we are in stagflation, and that shuts the door for any soft landing hopes because the Fed will increase rates under a weakening economy because inflation is sticking. And there goes the year-to-date rally. It's over. Kaputs. Meanwhile, on the bearish side, we get accused of being all over the place, flip-flopping and all of that. I say, no way. The bearish case has always been the same. Inflation morphs into stagflation, then it becomes a recession. The question becomes how fast you want to get to that recession, how much damage you want to see in the economy before we go into a recession. The way ahead for the bear case was, we're going to go into a recession. That's in the bag. It's going to happen. It's inevitable. The question becomes, are we going to go in a straight line into a recession? And that will only happen if the Fed sticks to the plan, stay on track, and continue to raise rates higher, not going down from 50 basis points to 25 and assume that the job is almost done. Because if the Fed does that, then we have to take a detour to that recession, the inevitable destination. This detour is called the inflation rebound, and it is a mistake by the Fed because the Fed signaled to the economy that they're not going to get the job done. They're going to allow inflation to go higher because they're erring on the side of not crushing the economy. But here's the problem. In this detour that we call the inflation rebound, and we're seeing this happening right now. Inflation data, be it the CPI, PPI, PCE, all showing that inflation has rebounded month over month. And now the Fed will have to act more aggressively and move us back into the recession road, which is again the inevitable destination. The problem is, when we get there using the detour, instead of going straight in line, more damage happens to the economy, and the economy gets surprised by moving deep into the recession right away, not in a gradual fashion. Had we gotten to the recession using the straight line, expectations start to adjust. You got the time as an employer, as an employee, as a consumer. But when we have the inflation rebound, we have the false sense of security that the job is done. And then the Fed surprises us with aggressiveness in raising rates. All of a sudden, the economy crashes. We see these massive crashes in the stock market, in the economy. And folks are not prepared. And that amplifies the damage all in all. Now, of course, the clueless chairman of the Fed, Clown Powell, has absolutely no idea what I'm talking about right now. He went on last month in the FOMC conference and said disinflation 15 times, giving the market the false sense of security that we have disinflation in the economy. And only a few weeks later, we got a confirmation that there is no disinflation process in the economy. We have a rebounding inflation. And all of this took place because of the false and weak messaging by the Federal Reserve. Inflation doesn't die, and the disinflation process doesn't start until the underlying conditions of inflation are gone. We have a lot of them, but I'll give you the three main ones: the aggregate demand, wage inflation, and low unemployment. We start with the low of aggregate demand. You don't say that inflation is gone, you don't say disinflation process until you have clear evidence that the law of aggregate demand is not going to kick in once prices go down, once rates go down. But of course, the Fed ignored all of the evidence that we got in hand. To begin with, take for example, when the company Tesla slashed prices by 20% to boost sales, to boost demand, what was the thinking by Tesla management? Kicking in the law of aggregate demand. They know that it is better to stimulate sales by getting less revenue by slashing prices rather than keeping those prices too high and the consumer waiting and waiting for prices to go down. Why not just do it right away? And once they did that, immediately the demand kicked in. A lot of you watching this channel right now told me, hey Maverick, this is a really good deal. You're talking about soufflés from Tesla and the prices are slashed by 20%. I'm taking that deal. And it was the smart thing to do because immediately the aggregate demand kicked in. Folks stampeded to buy these Teslas at a cheaper price. Be it in the US, be it in the EU, be it in China, consumers stampeded to buy these Teslas at a cheaper price. And immediately Tesla decided to reverse all of these price cuts. And they jacked prices higher again because they realized that the aggregate demand is really, really strong in the economy right now. The moment prices go down, folks are going to stampede. The moment rates go down, folks are going to stampede. Look, for example, what happened in mortgage demand. The moment rates went down because the Fed signaled to the economy that, yeah, maybe we're done with the job. Inflation is cooling down, or we're about to be done. Rates went down immediately. Mortgage rates went down immediately. And what was the reaction by the consumer? The aggregate demand kicked in, and immediately we saw a massive stampede in mortgage demand. It jumped by about 28% in a single week. This should have been clear evidence to the Fed that we have aggregate demand in the economy and the job is not done. Number 2, wage inflation. You don't declare that the battle against inflation is done until wage inflation reverses. When we look at the Atlanta Fed data, wage inflation remains way too high, be it for hourly or non-hourly wages, all sky high. Now you might say, hey Maverick, why would you wish for wage inflation to go down? Isn't this good for the consumer? Isn't this good for labor? The simple answer is no, because number 1, the psychology is important. And if workers are now expecting more in wages and employers are also expecting that they need to pay more to retain employees, it becomes a spiral and wage inflation gets out of hand, which also pushes inflation higher. And the end result of all of that is wages, all in all, when we talk about real wages, the lagging inflation. Americans right now, despite the wage inflation, are actually losing money to inflation because the rate of growth in inflation is higher than the rate of growth in wage inflation. There is a gap. And that gap means that despite your wages going higher, you're paying more for rent, you're paying more at the grocery store, you're paying more for utilities, you're paying more for services. All in all, you're losing money. And until wage inflation expectations are gone, you cannot declare victory against inflation. Number 3, low unemployment. This is a problem. The unemployment rate has to move higher before inflation is done. There is something called the Phillips curve, which basically says that as the unemployment rate goes lower, wage inflation moves higher. And as the unemployment rate moves higher, wage inflation goes down. Now you might say, but Maverick, we had low unemployment rates for a long time and inflation never showed up. You're absolutely right. The Phillips curve is dead. It's not applicable. However, once the inflation cycle begins and it gets out of hand, the Phillips curve becomes applicable again. The Phillips curve is activated in the inflation cycle. Why is that? Because of psychology once again. Expectations become built up in the economy from both the employee and the employer's side, and as the unemployment rate remains low, employers think that they have to pay more to attract new employees. New employees think that they have the bargaining power and they demand higher wages. So the Phillips curve is only activated now under the inflation cycle, but it's dead when we don't have inflation. You can have low unemployment in the economy with no inflation. That's absolutely possible. But after the inflation cycle begins, the Phillips curve becomes applicable. In summary, to defeat inflation, the Fed must defeat aggregate demand in the economy. To defeat aggregate demand in the economy, you need to defeat wage inflation. To defeat wage inflation, the Fed must defeat the low unemployment rate, meaning we need to see more and more layoffs, more and more unemployment in the economy. Unfortunately, of course, but this is the way it is. Now, the other rebuttal against the bears is, what recession? What are you guys talking about? You guys been fear-mongering about a recession for about a year now, and there is no recession. The consumer continues to spend. Everything is pretty good. How can we have a recession when we have a low unemployment rate and a consumer that continues to spend? Here's my answer. The recession climbs its way higher, from the poor all the way to the rich. But usually it stops before hurting the rich because the government interferes, be it from the Federal Reserve side or the fiscal policy, by initiating bailouts and all of that. What we know now for sure, that inflation so far absolutely wrecked the poor and the lower middle class. When we talk about the poor, just look at the homelessness crisis that we have in this country. Under every bridge in this country, you get to see homeless folks all over the place. That's due to inflation. The problem did not begin with inflation, but it did exacerbate the problem because rents went haywire, housing housing became unaffordable, a lot of folks became homeless. When we talk about the lower middle class, we know they're getting annihilated. Just look at the earnings from stores and companies that tend to serve the lower middle class. For example, today we got earnings from Ross. Now, I shop at Ross. A lot of you shop at Ross. It is not exclusive to the lower middle class, but they are the main consumer in Ross stores. The company says that rising prices continue to hit lower income shoppers, and they missed expectations. They bombed earnings. So we know that the lower middle class consumer is getting absolutely wrecked right now. And we know that the mid-class consumer is also getting severely hurt. They're bleeding right now. How do we know that? Look at a store like Target, for example, which reported earnings today. Target reports 43% drop in profits from the holiday quarter, and they're cautioning about 23. If the consumer is not even spending in the holiday season, they're running out of cash. Why are they running out of cash? Their disposable income is now being locked in higher rents. You hear all of this talk from the talking heads on TV saying, oh, but rents are going down. It means that the CPI should go down. Inflation is going down. But the annual change in rent for all tenants is actually moving higher and higher and higher. You know that. You're paying more. Everybody's paying more. Now combine this with higher utility bills, with higher bills at the grocery store, at the gas station, and now the majority of your income is locked in and spending for necessities, for rents, groceries, utilities, gas, car payments. The middle class is running out of disposable income to stimulate the economy, to take trips, to vacation, to spend at restaurants, at apparel stores. And when they do that, they're only able to do that because of debt, because of credit card debt. We know that household debt hit a record, almost $17 trillion. Oh no! Out of that, about $1 trillion in credit card debt alone. This is a disaster in the making, with rates moving higher, and folks have over $1 trillion in debt, in credit card debt alone. What do you think we're heading here, folks? We know that 72% of all of that credit card debt has been added in the last year alone. Oh my God! Matter of fact, 48% of all Americans say that they're only using credit card debt to cope with inflation. They have to. They got no other choice. And today we got the stunning data that a record 36% of U.S. adults now have more credit card debt than savings. Unbelievable. So we know that the middle class is about to get wrecked. Just a matter of time. Now we go to the upper middle class. These are the tech workers, the software engineers, the Silicon Valley types, folks who work in Wall Street, for example. We know that this class is getting cracked. They got hit really hard with the tech layoffs, for example. But the beauty with this class is they're getting paid a lot. At least they used to, until they lost their jobs. But they got a lot of savings. They got a lot of investments. They got a lot of home equity value. They got a generous severance package. What are they doing right now? They're taking the time off to vacation. They're buying Airbnbs. They're booking hotels. They're booking flights and cruises. No wonder why we see good results from the airliners, from companies such as Booking Holdings. The company says revenues were up 36% on strong travel demand. And that's only possible because the upper middle class, the tech workers, are exhausting their savings in booking these vacations. And the middle class is using credit card debt to book vacations, flights, etc. But this is unsustainable. We know that. And that leads us to the rich. For now, the rich are doing pretty good. We'll look at the American Express CEO, for example. No signs of a recession at all. We saw the results from Amex, sky high. Folks are using credit cards, no problems here. But we're starting to see signs of trouble. Take, for example, luxury store Neiman Marcus. They're now getting rid of employees because business is slowing down. We know that the rich is the stock market / the real estate class. The majority of their money is tied up to stocks and real estate values. When, not if, but when these values go down big time, they get hit too. And that will be the final stage in this recession, hitting one class at a time. So when I hear folks say that the economy is confusing, it's a challenging time, maybe it is. But for me, folks, it has been clear. I'm not confused at all. And I hope after watching this, you're not either. With that, folks, let's move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average was down by 232.39 points, or a decline of 0.71%. The Nasdaq was down by 11.44 points, or a decline of 0.10%, while the S&P was also down by 12.09 points, or a decline of 0.3%. We look at the sectors all in all, at number one capturing the gold, the silver, and the bronze. How about materials? The outperformer for the day, thank you to gold. And gold managed to outperform on the face of the dollar, also moving higher. We'll talk about that more in the futures and the charts analysis. Yet the laggards of the day led by utilities, energy, and healthcare. When we look at the advance to decline ratios, the NYSE 49% advancing versus 50% declining. The Nasdaq 54% advancing versus 43% declining. All in all, despite the negative closing for the day, we're still neutral, folks. The market haven't made a move one way or the other yet. When we talk about futures, what do we see here in the commodities cohort? While the dollar was slightly up, all in all, most commodities were in the green with the exception of grains. We saw major losses here for corn, soybean meal, soybeans, and oats futures, all down by more than 2% for the day. On the other hand, energy commodities managed to outperform, led by the WTI versus Brent. The WTI was up over 1.5%. Brent was up by almost 0.75%. Gasoline RBOB also scoring major gains, north of 2%. Heating oil was the laggard today, be it muted, almost in the flat line, and the rally in natural gas goes on. Although natural gas was down earlier in the morning and then staged a major comeback, closing positive by north 1.5%. When we look at softs, the decliners were led by sugar, followed by cotton, and then coffee futures, while the gainers were led by lumber, followed by cocoa, and then OJ futures. Now, bear in mind that lumber usually rallies hand in hand with the equities market. So did lumber futures today predict a rally in equities? That is something to keep in mind. When we talk about metals, in the green all in all, led by copper, followed by platinum, silver, and then gold futures. How did that happen, even though the dollar moved higher today? My hunch is we have some end-of-the-month reshuffling, and therefore we have gold moving higher along with the dollar. We'll see what happens tomorrow. If the theme continues, then something is going on. Either the dollar or gold is lying. But if we see the picture reversing, with the dollar moving higher again and then gold moving down, then we're back on track, and the expectations are for the Fed to do more tightening. Moving on to the big casino, the options market, what do we see here? The volume all in all is down, which could be indicative of the retail mom and pops running out of cash. They've already exhausted all of the reserves chasing this rally. Yet we continue to see the ratios tilted toward calls versus puts once again. And the hottest name, no surprise here, Tesla, the souffle, with around 1.6 million contracts traded today. About 62.5% of those were calls. And at number 2, AMC was down big during the session and then down yet again in the after hours. The heels of an earnings report, beat at that about 1.2 million contracts traded for the name today. About 52% of those were calls. And at number 3, Meta. We got a gamma squeeze in Meta. The volume surged higher by about 600,000 contracts, and about 66.5% of those were calls. And the question becomes, why did Meta outperform everybody today? The answer is, look at the gamma squeeze. We'll look at calls with the expiration date of this Friday. Beat from the 170 all the way down to 187.5. The volume was out of whack, a stampede here, with the hottest contract being 180, about 72,000 contracts traded hand for this one alone. On the other hand, we'll look at puts, no resistance at all. Yes, we have some volume, but it paled in comparison with the 180 calls, over 70,000 contracts traded for that one alone. So the market maker, aka the dealer, gets the feedback and says, okay, we have folks buying more calls than puts. They're looking for 180. I guess I'm going to have to buy some shares of Meta here and see what happens by the end of the week. Now, if these call options holders are not serious about buying the stock, they just want to chase quick profits via calls, and they're not going to exercise these calls, then by Friday, you're going to see the dealer dumping all of these shares from Meta. Let's move on to the unusual activities that took place in the options market today. We begin with the ticker AMGN for Amgen. I've been waiting to enter this name, and maybe it's going to go down here and give us a discount. At least according to this trade, somebody bought the 220 puts for the expiration date, March 17th, with expectations that Amgen will move down and lose more than 5% of its value by then. They paid around 85 cents a piece to enter. This trade, all in all, spending around $900,000. And then what about the ticker UPST for Upstarts Holding? Somebody's betting that the rip will fade away, and they bought the 17 puts for the expiration date, March 17th, with expectations that the name will move down and lose more than 8% of its value by then. They paid around $1 a piece to enter. This trade, all in all, spending around $800,000. And then what about the ticker SPOT for Spotify? Somebody sees it going higher, and they bought the 123 calls for the expiration date, March 10th, with expectations that the name will eke gains north of 6% by the expiration date, and they paid around $1.30 a piece to enter. This trade, all in all, spending around $800,000. And last but not least, here it is. What about Meta? Here we have somebody chasing the squeeze, and they bought the 192.5 calls for the expiration date, March 31st, with expectations that the name will gain more than 10% by the expiration date. They paid around $2.50 a piece to enter. This trade, all in all, spending around $1.5 million. Onto the heat map, what do we see here? Mostly the risk-off segments getting hit really hard today. Be it pharmaceuticals, be it healthcare, be it utilities, be it the consumer defensives, and even energy. The inflationary theme also got hit today. What managed to outperform is not the risk-on theme because big cap technology stocks lagged today, be it Apple, be it Microsoft, with Meta being the exception, of course. Even Tesla lagged, Nvidia lagged, but due to the options market activities, Meta managed to outperform. When we talk about the laggards, look no forward than Goldman Sachs. The ticker GS was down big. We have a lot of problems here with Goldman Sachs. There are calls that the CEO should be better off DJing and selling hot dogs than leading Goldman Sachs. Lots of volatility here. My sources say that the CEO is embattled now. And with this chaos, with this uncertainty going on in Goldman Sachs, no wonder why the stock is down. My bet is the moment we get the news that the CEO is resigning, Goldman Sachs will pop higher again. And a major loser today was Dish Networks. The name was down big, and today we got a confirmation of an outage that started last week, impacting all of its websites, customer call centers, and they're now calling it as a cybersecurity incident, quote unquote. They're not saying an attack. But something major went wrong here, and the company's stock is down big. Then we have in cruises, in travel names, they're all down big today. And the reason is we got results from Norwegian, not good. Shares were down over 10% today. The outlook is not good. Losses are accelerating. And if Norwegian is getting hit, you can only imagine what's going on with Royal Caribbean and Carnival Cruises. Two names shittier than this one. And then let's talk about Tesla. Maybe it was supposed to move higher based on this news because we got Mexican President AMLO. He announced that Tesla will open a factory, a new plant in Mexico. I don't know if this is real or not, or whether AMLO is in trouble and attempting to save his ass. I don't know. Yet the stock went down based upon this news. When we look at the heat map for the ETFs, all in all, no major move by the dollar, but yields were slightly higher, and therefore we have utilities down big, the XLU, some weakness in the real estate cohort, IYR, V&Q down. The dollar made a rebound by the end of the day, but energy all in all was down even before the rebound by the dollar. We could see that the XLE, XOP, OIH all down big. The exception being Nat Gas, whether we're looking at the ticker UNG or your favorite BOIL, all moving higher for the day, although at some point they were negative. And again, the mystery becomes, why did the GDX gold miners outperform today? We'll see what happens in tomorrow's activities. Yet the outperformance by the GDX was good enough to move the XME, the materials ETF, higher for the day. We also have an outperformance by the XBI, biotech. We have a lot of M&A activities, Pfizer buying this, Amgen buying that, and of course the XBI is moving higher upon this news. When we look at internationals down across the board, be it Chinese ETFs, Europeans, Brazil, all down, we're going to wait for further guidance by the dollar. If the dollar pops higher again, international markets will underperform. Now let's do some charts and then wrap it up. And we begin with SPY, the S&P 500 30 minutes chart. What do we see here? Zigzagging back and forth at around the support of 398. And the reason is the phenomenon of zero date till expiration options. They buy calls, they buy puts, and they close them, then open them again. And this confuses the market maker. The dealer doesn't know what to do. Do they buy? Do they sell? They have no idea. They have to follow the action in real time. And at some point, the dealer is going to get really frustrated. And they're going to say, you know what? To hell with it. All of this chaos. I'm going to dump all of the shares that I got to reset all of these expectations. And that could produce a massive flush down. And perhaps this is exactly what happened by the end of the day. And the reason is the SPY managed to close below the support, now resistance of 398, closing at the lows of the day with higher volume. All in all, the bear flag did play out. Now we got support number one, the obvious, the gap. And if the gap doesn't work out, then we go down to 393.16. This is the number that I got, but it is soft support. I would not be surprised if the SPY rebounds from, let's say, 394 or 393, because this is soft support after all. Perhaps for better guidance, we have to look at the daily chart for the continuous contract for the S&P. All in all, nothing happened today. It is still trading above the support of 3,960. If we have a closing below this number, then we have a breakdown, more acceleration of selling. Absent of that, we are still range bounded, folks. Be it with that, the volume is moving higher. The momentum indicators, be it the RSI or the MACD indicator, all in negative divergence, indicating a lot of weakness here. The chart is consolidating in a bear flag pattern. If the buyers don't show up to rescue this chart, the inevitable will happen, which is a loss of 3,960, and down we go. When we look at the monthly chart for the SPX now that we closed the month, doesn't look good, folks. It appears that we are in the return to normal phase, and if the next phase is fear, then down we go all the way to the trend line, and that would be a loss from this point on worth about 22%, not more. When we look at the Qs, the Nasdaq, 30 minutes, what do we see here? A similar story, zero date till expiration phenomenon, pushing the chart back and forth, and around the important support of 294.33. But again, by the end of the day, we got a flush down, the support is lost, and now we have the gap, that is the obvious support number one. If it doesn't work out, we go down to 290. When we look at the daily chart for the continuous contract, doesn't look good. We are still below the important number / resistance at around 12,207, and if we can't have the energy to crack above it again and reclaim it as support, down we go to the actual support, the next one, 11,689. For now, what we know is RSI, MACD, all in negative divergence, indicating negative momentum. The volume is moving higher, indicating more selling is going on. The chart is consolidating in a bear flag pattern. If it plays out, down we go to 11,689, and that will erase the entirety of the February gains. When we look at the index, the monthly chart, again, really bad candle here, folks. And if this plays out, down we go to the trend line. That would be a loss of around, let's say, 26% at a minimum. IWM, small caps, 30 minutes. What do we see here? A similar phenomenon, caught support from 188. It looked pretty good. Higher we go, and then came the U-turn by the end of the day. The beauty of the IWM, it did not close below the support of 188. So that remains support, and this chart offers the best hope for the bulls at this point. We'll look at the Dixie daily chart, still above my support number of 104.58. And if the momentum continues, we can go all the way to the next resistance on the daily chart, which is at around 105.63. Yet when we zoom in, you can see the importance of my number. 104.58 continues to hold on as support. We got a closing above it. When the dollar made the U-turn and closed at the highs of the day, we saw the equities market, the SPY, the Qs, the IWM, all reversing and closing at the lows of the day. So we know that the algos are still tracking the dollar. The question becomes, will the dollar continue to rally in the month of March, or will it go down and lose momentum? For now, what we know, the next support from an intraday perspective would be 105.11, which is the top of a breakdown candle. Then we take it from there. If it is passed, then we have to look at the daily chart resistance level. But let's see what the old man says here. Gold caught a rebound today, but not closing above 1,842. We know we have some oversold conditions here. It is playing out. The problem is, what if it plays out, fixing the oversold conditions, but the old man doesn't recapture 1,842? If that takes place, then it solidifies the case for the dollar to pop higher again and for gold to move down all the way to 1,763. When we look at Brent oil, a daily chart, what do we see here? No update. Above the line, so far so good, but it needs to make a higher high ASAP. We got an obstacle here in 85, which is a sticky resistance, and if oil passes this number, then we're talking about a higher high possibility. For now, we are in no man's land, and therefore I say, if you're not already in energy, wait a little bit more. Wait till we get further clarity here. A break either above 85, making a higher high, or break below the trend line, and we get the series of perhaps lower lows. What about the 10-year yield daily chart? What do we have here? Consolidating below 4, waiting for the signal to pop above 4%. But it is losing momentum at this point. It needs the spark. It needs to secure 4% as support ASAP. Otherwise, the risk becomes to the downside and revisit to 3.8%. When we look at the TLT daily chart, it caught support exactly for my number, which stands at 100.28. So far so good, but if this is just a mere rebound and the 10-year yield makes it above 4%, then the TLT will lose this support once again. Now, what about the VIX 4-hour chart? What do we see here? We have a break below the consolidation pattern. It made a lower low. We're now back at 20. Maybe we're going to retest 20 as support once again. But the most important chart here is the weekly chart, and we're looking at the MACD indicator for a confirmation that the VIX is moving into positive/bullish momentum. The week's still young, so we don't have a confirmation yet, but it's just a matter of time here, folks. At some point, be it this week, next week, the week after that, the momentum will turn positive for the VIX. We will see a big pop, which will be accompanied by a sell-off in the SPY, the S&P 500. Now, what about Apple, the big kahuna, 30 minutes? What do we see here? Retested 147.5 as support. Looked so far so good. We're going to 150, and then came the U-turn as the dollar made its own U-turn to the upside. Apple made one to the downside. downside and it lost 147.5 as support by the end of the day. Is this bullish or bearish? The answer is it is bearish. Now, what about Tesla, the souffle, 30 minutes, or excuse me, an hourly chart? We have a trend line, acted as support over and over and over again. This trend line has been lost, but the chart did not lose momentum. We have a lot of buying of call options. We know the catalyst is coming out tomorrow, the revelations of the new master plan or whatever Elon is selling right now. The question becomes, what if it is a bust? What if it is a nothing burger? Because right now is for lower highs, indicating that the chart is losing momentum. It is waiting for the revelations. If they're not good, we will see a massive flush down. Buy the rumor, sell the news. If the revelations are exciting, then the positive momentum continues. But understand this, the bar has been set too high. And the reason is the rally is north of 100% year to date. Whatever Elon is going to reveal, it's already priced in. We zoom in to today's activities, still using an hourly chart. What do we see here? Maybe the possibility of a reverse ABC pattern. If the event is disappointing, down we go to 200. If that doesn't hold out, we go down to the next support of 194.55. Last but not least, what about Bitcoin? No update here, still holding on the support of 23,189. You know my take. My take is down we go to 20,593.34. But don't take my word for it. I've been wrong before, could be wrong again. Do your own homework, and if you see the dollar moving down, losing support, then there is a possibility of Bitcoin popping higher again. But I do encourage you to do your own homework. Don't take my word for it. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the PMIs and ISM readings for manufacturing. We also have construction spending, all important readings. But the most important event is what Minneapolis Fed President Neil Kashkari will say about inflation and the path ahead for the Fed policy. With that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Take care.
Well, for me, the action is the juice. I'm in.